So we've talked about trading securities, we've talked about available for sale securities, and now we are at the held to maturity securities. Held to maturity have got to be bonds because they're the only ones who have due dates. Stocks, they don't have a due date. Bonds are always, they have a maturity date or a date when they come due. So the held to maturity category is one where management has the intention and ability not to sell these debt investments until they come due. So they're really hanging on to these. They're going to get interest payments, they'll get interest revenue every 6 months or so on most of them, and it gives them a steady stream of cash flows that they can fairly count on. So these are investments that are held primarily for the revenue that they provide. Since there's no intention to sell these, we don't report them at their fair value on the balance sheet, and we don't recognize any unrealized gains or losses. These are reported at their amortized cost, which means that they would be on the books as investment in debt securities, less any discount or plus any premium. We really don't go into the reporting for that in this course. As far as this category of investments goes. So held to maturity, what you need to know, they're held until they reach their maturity. Not valued at fair value, they're valued at their amortized cost. And they would be reported on your balance sheet. Most likely it would depend on the management's intention as to when they would be sold. So why all these categories and accounts? If you think about it, what's the purpose of financial statements? It's to provide useful information. And so different information is relevant depending on the purpose of each investment. Held to maturity, no intention to sell it when it comes due, so your current changes in the market value really don't matter, and we don't report the unrealized gains and losses. The company could have the same debt investments that are in the held to maturity category, but they could intend to sell them sometime. They're not sure when. In that case, they might put them in the available for sale category. We plan to sell them sometime. If they plan to sell them soon, they could even end up in the trading securities category. If you had debt investments that your intention was to sell them in the near term, you'd categorize them there. So the trading classification on the financial statement, it just tells the investors that these are about to be converted to cash. They're about to be sold. So it makes sense to report them at their fair market value, and it also makes sense to report the unrealized gains or losses on the income statement. Available for sale, that tells the financial statement users that, yeah, this is a bunch of investments. We're not, we might sell them soon, we might not. We'll sell them sometime. These will be also reported at fair value, but we're not going to report the unrealized gains and losses on the income statement. They'll show up on the balance sheet. If these changes, the stock market and the values of the securities, it goes up, it goes down over the course of time. And if you have securities that you're going to sell sometime, well, their price could plummet this year, but then be recovered 2 years out. And so if those changes on available for sale were reported on the income statement, they would make the income statement much more volatile. It would have high income one year and it would take big losses the next. And that really would not be providing useful information. It would be somewhat misleading because there was no intention to sell them. Okay, so I think that's about it for our trading available for sale and held to maturity.